warm welcome to all of you to PDS Analyst Meet 2025. Today we have with us the senior management team of PDS. Along with that, we also have senior business leaders. So it will be an interesting session for you all. I'll request you all to kindly keep your mobile phones on silent. And also we have a Q&A session towards the end. So any questions should be taken towards the end and not during the speakers speaking. Without further ado, I'll now call upon Sanjay Jain for the opening address.
Welcome to the Investor Day meet. Yeah, I think it's exactly 12 months. Last year, of the same week of June 24, that we had our first Investor Day. We're happy to have the second anniversary. Here are the speaker lines up. I'm just going to get out from here in 2 minutes time and then hand over to Palak to walk through the overall PDS strategy. Last year we shared with you 555 journey. 1 year has since passed, so where are we on that? Then we have Rahul, our CFO, coming up, talking through operational excellence, financial update, capital allocation. While through various interfaces, analyst call, investor days, investor presentations, many of you get to meet Palak and Rahul, and I also get to meet you. More importantly, we've invited 3 of our business heads to be here with us. First and foremost, we have Mr. Rajneesh Kapoor. Rajneesh is based in Dhaka. He handles close to 100 million top line business. But he runs a business with more than 7% net profit margin, one of the most profitable businesses. His business is focused on largely on North America. So one of our first business heads out of 3 that we requested to be here is to represent 2 characteristics. Number 1, a business focused on North America. And number 2, how in our kind of business, wherein we are aspiring from a 2% PAT to gradually 4 to 5%. One of our verticals is actually making 7% profit margin. The second person is Steve, who has traveled from UK. He leads the New Lobster business. That's where the Ted Baker brand management is there. And we requested him because we felt that Ted Baker has been over the last 2 years one of the key investments for PDS. From the point that he took charge, there has been a journey full of challenges. So we wanted to share with you how Steve, as the leader, as the CEO of the business, has overcome those challenges. And somewhere probably all of us towards the end of this presentation come to this conclusion that the worst is behind us and we should only get better from here. So besides the journey of New Lobster thus far and the roadmap ahead, is also bringing in one more characteristics of a new line of management called brand management for us. So Rajneesh covering North America, and then Steve covering brand management, and then lastly we have Eric, who's just settling in. Eric is from origin from North America, right now based in Hong Kong, and he represents again 2 very special USPs. On one hand, he is conducting a sourcing as a service business. Today, the business that he handles, the GMV is getting closer to 300 million. But more importantly, he represents home and general merchandise. So one of our newer offerings. So therefore, when PDS has built a franchise of some wonderful relationship across various geographies, we have Eric as a business leader trying to help us get a larger share of wallet through a new offering of home and general merchandise. And lastly, and very importantly, we have a special guest who on a request, took some time out of a busy schedule. He's probably just walking in, should be here any moment. His name is Henry Stuck. Henry is president for EMEA region of ABG. ABG is Authentic Brands Group, who owns IPR of many retail brands to generate close to $30 billion of retail sales. And Ted Baker brand that we manage is actually owned by ABG. Another brand that would resonate with us here in Mumbai is Forever 21, that also is owned by ABG. So we wanted to get his perspective on what is ABG's larger game plan and how, most importantly, not just Ted Baker, how from an ABG lens this ABG PDS partnership can lead to many more things to happen in future. So that's how we have carefully collated in a way the speaker suite for you. I think very happy to share this is the 25th anniversary of PDS. While from a legal perspective, we got demerged out in 2014 from the erstwhile company, but somewhere within that erstwhile company called House of Pearls, this business actually started 25 years back as a division, and today we have completed, this is the 25th anniversary. We've grown over the last history since 2014 at about 11-12% CAGR of revenue, but most importantly, double of that in terms of PAT growth. And this growth has weathered a COVID crisis across various countries or so. Last 2 years, we've been again into a kind of investment mode, wherein the growth, while has been in mid-teens, the profitability relatively looks subdued, but that's the nature of our business, that the investment actually happens through P&L, and then after a 1 or 2 year lag, the profitability comes back. But if 2014 to 2025 is a testimony to PAT growth being double of the top line growth, is what gives us confidence that as we travel next few years ahead, we should be able to repeat that. We shared with you last year that we have adopted a 555 ambition, I would say a dream and ambition, wherein we felt that in a 5-year journey, we would actually do about 5 billion of GMV, gross merchandise value. It translates to about 70% of that as our top line, 3.5 billion. And we felt that in 5 years we could get there and aspire to get closer to 5% PAT on that turnover. We are a little ahead, 2 years into the journey. We are a little ahead in terms of the GMV. We are about 45% or so. On profit, we are closer to 20%. So we have a catch up to do. I think, but that's the nature of the business, that we invest through P&L and then we try and put in efforts to get the profitability out of it. So today, when we have requested your time, thank you so much, all of you coming here, spending 2-3 hours. Allow us to share with you through Palak's lens, the journey alongside this, 555, and through Rahul's lens on the profitability, and then my 3 business colleagues to share the underlying blocks. And post that we are available for Q&A. Thank you and welcome once again. Palak, over to you.
Thanks, Sanjay. So, Sanjay set the context. He's the CEO of the company, great support for me and the PDS team to take the company forward. So we just talk about overall PDS business, where we stand. We started our investor roadshow last year, was the first roadshow, so this is a follow-on from there. And we plan to do an annual event where we talk about the company, what our plans, and how the company is moving forward in the years to come. So there are a few things I'll be covering. So first of all, just to lay context, some of you might be new here in the presentation, might not have had experience of what PDS business model is. So we consider ourselves one of the world's leading entrepreneur-led global fashion supply businesses. Right? We do around 2.2 billion of GMV, $1.5 billion of revenue. We have large working capital limits from the banks, which is a great asset. So almost $550 million of working capital limits from banks in Hong Kong and Dubai, which has taken 25 years to build. It's not easy to have this level of limits for working capital, which is the lifeblood of our business. We do 1.3 million pieces a day and close to 500 million units a year. So there's huge scale in the business. We are truly a global company. We have 22 country operations, almost 90 plus offices. So it's a very global business. In all the geographies, we have offices either servicing our customers or the key manufacturing sourcing locations, teams sitting controlling supply chain, and around 10,200 employees and factory associates. So this is, just a bit of numbers about PDS. In terms of business, we are still predominantly apparel. So 88% of our business is apparel. But around 3 years ago, we got into new categories, and around 10% of our business today is home, and 2% is others like footwear, accessories, and beauty categories. So if you look at PDS, in the middle is the logo. So PDS is a platform, it's a holding company, it's an aggregator of all these businesses. So all these companies mentioned around the logo are our subsidiaries. Each of those subsidiaries are run by management teams and they are shareholders in the business with us. So today, like Sanjay just in his presentation mentioned, Eric, Steve and Rajneesh, who are running few of our subsidiaries, will make presentation about their business model. But there are many businesses here which have a unique business model, a unique USP that add value to their customers because of which they survive and do business. So it's a 40 plus verticals working with almost 250 retailers and brands. So we are proud to say, we are probably the only company not only coming out of India, but globally, which has been set up as a platform with an entrepreneurial culture where various entrepreneurs are running various business companies. So PDS, we are a product company at heart, we are a design company at heart. But from a product company, we feel today we are a services business. So what are the services we provide? So when we meet the retailers, we present to the man of Walmart, Target, Next, Zara, Inditex, H&M. So when we meet the big retailers, we showcase PDS capability. If I go today just saying, I'm a manufacturer, a factory somewhere in Asia trying to present product, I think there's limited value. Or you're just a supplier trading, there's limited value. But when you present yourself as a services business, so there are the 5 services we do. First is design-led sourcing. So we have around 300 designers across our 40 subsidiaries. We design into the private label of the retailer. So the retailer owns the brand, like Zara brand, PDS is designing into their brand and supply them product. Second is sourcing as a service, where maybe Eric will be presenting later, where we run retailer sourcing operations, right? So retailers today don't want to have the infrastructure of 500 people across 10 countries in Asia. They said, can you guys take it off our balance sheet and run it? So PDS does that as sourcing as a service. Third, category management. So where retailers are today outsourcing the buying departments. In the West, there's a big trend where retailers are like, if a vendor can give them the intake margin at the retail prices they're selling, they say, can you handle the whole category? So we are talking to some of the supermarkets in Europe where they say, menswear, can you run the whole thing? Give us the intake margin at the retail prices and then, you don't want to interfere in the product design, sourcing. As long as they get that, it's category management. And the food business exists, it's moving to the clothing business as well. Next is brands. So, we've got Steve here from News Options, which will present about our brand management journey with Ted Baker. Henry Stubb kindly also agreed, and he's the president of ABG, like Sanjay introduced. He'll also be talking about the brand management of PDS. And then finally, manufacturing. So, we want to be asset-light model. A manufacturing business will be around between 5 to 10% of our turnover, depending on how fast other business segments grow. All this on a strong platform where we feel we have strong leadership. We have a lot of credentials on ESG. We are a financially stable company and we use technology to our best advantage as an enabler to move our business forward. So what makes PDS different? When I present to my customers, I think the presentation I'm showing is like I'm pitching to a customer. So when retailers say, what makes you different? So one is our scale and speed, right? We are a global company, we have huge scale. We say we are a listed company, but we have the agility of a startup, right? So because of our entrepreneurial model, we are like a startup, we can move things fast based on market need. Second, we are a solutions company, so based on retailer requirement, we provide bespoke solutions, and that also helps us to differentiate ourselves. Third, we are a very transparent business. So when we meet a retailer, they know that if PDS is saying something, they commit to something either through a financial model or through sourcing strategy or through compliance. We are very transparent and we follow that. And I think retailers are very comfortable to have PDS a seat on the table in all global forums because they value our transparency and the ethics of our business. We're an entrepreneurial model, right? There are a lot of equity holders in the company. Wherever we have bureaucracy, we try to kill it and we try to bring in entrepreneurship. Because that's the only way our industry and our business will survive. We have a global reach and like I mentioned earlier, large working capital limit. So combination of all this makes us different and unique in the industry and in the business. So Sanjay outlined our 555 strategy. We've been, almost 2 years into this, and we have 3.5 years more to go. It's a journey, it's ambition, it's a goal, but we have to go towards it. So from my point of view, 5 years, what is 555? 5 years, 5 billion GMV and 5% PAT. So basically, 5 billion GMV counts around 3.5 billion of revenue. Rest is sourcing and services, agency business. And to achieve that, we need to have good quality growth. Because honestly, I can achieve this in next 2 years, right? If I play the arbitrage where there was a big company in Hong Kong called Lian Fund, right? Great business, we modeled PDS a bit around them. They were buying businesses, they were trading at 50p, they were buying at 7-8p. They kept acquiring businesses and very quickly aggregated a lot of businesses. They had 100 businesses in their portfolio over 7 years. Reached a $22 billion turnover at peak. Today are down at $2 billion, right? Because they just make sure they have these plans and they achieve it. Whereas PDS, all our investments are through guardrails. Everything we do is through cash flow, through P&L, and through free cash flow we are investing. So we're not investing, we're not paying people to exit. We are bringing people, partnering with them to grow. So Lian Fund pays to exit, PDS partners to grow. So that's the fundamental difference. They were playing the stock market game, acquire at X, play the value arbitrage. We are only playing the long-term cash flow P&L game. I'm not interested to play the stock market game, right? You need to have good quality numbers, good quality growth, keep a healthy business, and then long-term, everyone will benefit and gain from our business model. So what are the guardrails, right? So no growth for growth's sake. I think this is very important. AAA credit-worthy customers, right? Today, if I open my business to any retailer which has risk, we can really gain a lot of business. But we're very sure, unless their credit insurance or the security of payment, we don't want to do business. It's very important. You want to focus on higher return on capital employed opportunities. So this is also a journey where PDS is getting sensitized to ROC. Typically, we focus on cash flow, P&L, but ROC is very important in the asset-light model. And all our business heads are being informed with the importance of ROC in their particular vertical. And no compromise on 6C and I principles. It's a bit detailed, but it's basically a risk management principles. So we want to make sure we don't take any credit risk, we don't take any inventory risk, we don't have any customer dependency. So it's a well orchestrated risk management framework. So to reach our 555 goal, we need to have good quality revenue and make sure we focus on these guardrails. So just quickly on the macro environment, right? The world is in a turmoil, right? We've seen the President Trump coming, he's doing a lot of things, he's shaking up the whole world, and there's a huge consolidation. So any business in this environment that does not have a strong balance sheet cannot survive, right? Especially in the West. And many businesses, unfortunately, over the last many years, have been bought by private equity, where the equity has been stripped out, there's huge debt. Many of these businesses are EBITDA positive but PBT negative. So there's a huge issue in the global economic environment, and consumer and retail is not immune to it. So definitely, consolidation continues. Only strong businesses with strong balance sheet will survive the next 2-3 years. There's a big ESG rethink, right? Again, with all diversity, inclusion not being talked about, all global warming being talked about as fake news, Paris Accord being removed. So all the good work last 10-15 years that happened in ESG today is being reset. So there's an ESG rethink in the world happening as well, and we see that from the conduct and behavior of our customers. There's a post-tariff world, so President Trump putting tariffs, unfortunately, I guess it was President Trump's slide, but yeah, so in the post-tariff world, there's a lot of opportunity for regions where lower tariffs will come. I think India is definitely going to benefit from it based on the negotiations that are happening. There's AI disruption. We were in World Retail Congress. The whole discussion for retailers was how AI is going to disrupt demand forecasting, how AI is going to disrupt design, and how AI is going to continue to disrupt business models. So it's again huge disruption and more responsibility on vendors. So when retailers are under pressure, they want to cut costs and they want competent vendors to provide them solutions. So definitely there's a big macro economic play here. So this brings opportunities for stable businesses, right? So what are the opportunities for PDS? One is managing retailers' sourcing office. So retailers saying we don't want 1,000 people across Asia in 10 countries, then PDS run it. So we are seeing more of those discussions happening in a very structured manner. Second, add new countries of geography. So based on PDS asset-light model, customers don't like if you're a large manufacturing player, a retailer will say set up a factory, then I'll do business. Because of PDS asset-light model, if you set up an office in Africa or Central America, as long as we have competent management team, which is our strength to hire the best people, they start business with us in those geographies. So add new countries, not having factory to mature, but bringing services with best quality people, come joining us, setting up offices, we start getting business coming quite quickly. Brand and category management, New York IT companies, Henry's here talk about ABG model. We are acquiring many more brands, people like us can operate those brands, pay them royalty. So definitely there are options for PDS. And then fast production, Sheen model, Temu model, definitely is the way of the future. Small quantities, many SKUs, fast reaction. So PDS has set up a business to do small quantities and short lead time. So based on macroeconomic, there are the 4 areas we see opportunities, and PDS already has seeds or established businesses to take care of these opportunities. So how is PDS adapting, right? So basically, keeping a startup mentality. We say we're a 25-year-old startup, right? Which is important. All our teams have agility and think like startup. They don't think like we are a large conglomerate with 90 offices in 25 countries. Keeping business asset light, services business, right? Moving from a product to a solutions business is important. And finally, we have PDS Ventures, which brings a lot of credibility to our business model and brings the respect from our customers to come engage with us in a more meaningful way. So case study, I just talked about the fast production model. So we set up a company called PDS Online Enterprise, which basically is offering our customers 1,000 styles a month with 300 piece minimum quantity. So we have teams that we have onboarded from certain retailers in Europe, which were online retailers, and we're providing that service to our current brick and mortar customers, but also other online players. So this business alone could be a $100 million business for us with a very healthy bottom line. There's a test and repeat, small quantities, multiple SKUs. So regional strategy and customer engagement. Sorry, I'll just cover one more thing. You see the brand Vinted here? So it's a relatively newer company, and it's in France. Vinted is second-hand clothing. They sell second-hand clothing, and now it's become the largest retailer of clothing in France. So the largest retailer of fashion in France today is a company selling second-hand clothing. It just talks about how the industry is moving forward. Right? No one would imagine that a few years ago. So regional strategy, customer engagement, just UK and EU is around 70% of our business. It's a market where there's huge consolidation, but we are very fortunate. We've been building in this market for the last 25 years, and we have the best retailer accounts open. So even this market, the top retailers who have scale, who are headquartered in UK or Europe but having global presence, they are our strategic customers. So it's a very good position for us to be in. We have scale with this market. So just some of the customers we are working with here. So what are the opportunities we see, right? One, these retailers are cutting costs including design. They are under huge pressure cutting SG&A costs. Second, they're cutting the sourcing offices. So it's like cut restructure, right? They bring in big consulting firm, restructure, cut overhead, cut costs, so bring opportunity. Third, reduce capability to manage non-core categories. So this all plays into PDS advantage. So what PDS is able to do with this, restructuring happen at the customer level, offer sourcing as a service, offer category management, and attracting top talent to join us. So in the last 2 years, the trading director of Primark, he joined us to set up a business of fast production. The sourcing director of Asda, and she joined us on sourcing the service. Sourcing director of Sainsbury, he joined us to serve Sainsbury back. So some of the top talent in the European retail industry is actually wanting to join PDS and service our customers back. And they join us because they see us a company, no politics, no bureaucracy, no power sector, equal opportunity, mutual respect. So it's a culture which is well known in the industry that attracts people to come join us and set up businesses. So we are proud that we attract the best talent in the industry. I'm out of time, but let me just finish a few minutes. The US is 15% of our business. Similarly to UK, Europe, there's a lot of disruption happening there. Retailers and brands are also cutting costs in the US. It's running probably 2 or 3 years behind Europe. Europe started the restructuring earlier, but that wave has started, especially post-tariff world. Huge restructuring is happening. IT companies acquiring brands. They are going to continue acquiring brands in the next few years. There's a tariff turmoil and then retailer bankruptcy. So because of tariffs, there's going to be huge bankruptcies there. So unless you're working with the top 8 or 10 best retailers, maybe the next 20 or 30 might not survive the tariff crisis. Like people like Walmart, Target are actually paying tariff, making sure the shelves are fully stocked, so they'll be able to go and have goods that other stores will have empty shelves. So how that plays into PDS advantage, again, our services, sourcing as a service, fast production model, our nearshoring offices in Mexico, Central America, and Egypt for duty-free benefits, and investment in design. So when all this happening, we offer this. In the last year and a half, PDS has successfully opened a Walmart account, Target, Ralph Lauren, American Eagle, TJ Maxx, Ross Stores, Costco. So the top retailers in the US today have opened a PDS account. We're investing in teams to service them better, and none of these retailers are actually looking at opening new supplier accounts. So because of our business model, because of our reputation, we were fortunate that we've opened accounts with all the top US retailers. and it takes next 12, 24, 36 months to really scale up and make this business the last part of our turnover. But the good thing is, because we are starting from a very low base, the tariff impact is not much, right? So our China-US trade is less than 1% of our turnover, if even probably 0.5% of our turnover, and the balance 14.5% is Bangladesh in the US, other geographies in the US, where tariff impact is pretty limited. So just images from recent year, last few months of conferences. PDS was the title sponsor for Bharat Tech. Indian government, asked us to sponsor along with 2 or 3 other players. In the US, AAFA, APAL, and Footwear Association, PDS is sponsoring, so all the top retailers look at PDS, and we are the only supply company in the US and AAFA which is actually being invited to present based on our business model. Best of Bangladesh in Amsterdam, we talk about India-Bangladesh relationship. It's actually just 2 months ago when Best of Bangladesh happened in Amsterdam. The Bangladesh government said, you guys are helping grow so much business for that country as well. Why don't you help sponsor this event, right? It's a small investment, but it shows the credentials we have from all countries, because of equal opportunity we have with all kinds of businesses we work. World Retail Congress in London recently, we were again PDS on the stage. And here in the audience, we have the top retailers from around the world, from Central America to South America, Europe, Africa, US, looking at PDS, looking at our business, and then obviously bringing us the credibility to go and pitch for future business as we go about. And then more recently in Global Fashion Agenda in Copenhagen last week, where all these are retailers, PDS was sponsoring an award, and we were able to, it was through a venture activity, and we got so many leads as a result of this award. So just, ending my presentation there. I'm a little bit over time, but I invite Rahul to go and talk about the financials. Thank you.
Good evening, everyone. I would like to start by thanking you all for taking time out of your, busy schedule to be here for our investor meet. We appreciate you being here, and thanks a lot. So over the next 10-15 minutes, I will basically give you some perspective around numbers. Sanjay and Palak spoke about the PDS business model, the opportunities that exist in the market, the challenges we are facing, our 555 aspiration, and how are we addressing this opportunity that we have in our industry in the next short and medium term. So starting with some numbers here. So the key numbers for us are largely, so I'll present the last 5-year view of how PDS has grown in terms of top line. Revenue, by revenue here we mean what we actually build, the invoice sales. It's almost doubled in the last 5 years. It's a CAGR of about 19%. Our gross margins have also increased by an impressive 3.6% from a 16.5 5 years back to almost little about 20% in the last financial year. Our EBITDA has again grown by almost 19%, which means it's doubled. The green bar you see is basically represents the amount of investment that we do through our P&L. In our industry, unlike a brick and mortar company where investments are largely capitalized, in our industry we are an asset-light platform, and whatever investments we make for future growth are largely rooted through our P&L. Hence, we have tried to capture the growth including that as well. So the 19% EBITDA growth is minus the investments we have made to the P&L. If we were to adjust for that, obviously it's much higher in mid-20s. Our PAT again has shown a growth of about 13% in the last 5 years, and adjusted for the investments we do through the P&L, obviously a much better number. So here's a brief overview of our operating and financial performance related to our capital. Besides the capital that has been invested in the company, our main raw material is our working capital. And if you see, our working capital over the last 5 years has almost tripled. It was about 5 days into 2021, and it's now about 17 days. Our balance sheet has expanded. You would also see that we've broken this up into optimization phase and growth phase. Optimization is basically, during the COVID years, there was a lot of need to conserve cash, ensure that the business remains afloat, and that was kind of a optimization stroke consolidation phase that we went through. However, last 2 years, given the opportunity in the market, we have invested in growth, both organic as well as inorganic, and which has led to some expansion in our balance sheet. And later in the deck, I will also talk about measures we are taking to contain that. Our net debt to EBITDA is about 0.82x, and return on capital employed about close to 19%. Return on equity closer to about 14%. And as we progress the day, particularly in my deck and the business partners who will be running you through their take on their businesses and PDS, you will get to know how we are working on significantly improving in all these areas in short to medium term. So some highlights of the year gone by, which is financial year 25. We delivered strong revenue growth, closer to about 21% year over year, driven by both customer diversification and agile sourcing. We have one of the measures that we monitor very sharply in our business is our order book. Our order book this year is closer to, at current point of time, about $600 million, which is about 14% more than same time last year. So basically, our order book is typically tells us about the next 4 to 6 months. So H1 is pretty much looking good as far as what our order book tells us. US market expansion, I guess a lot of you participate in our quarterly earnings call, and US has been a focus area for PDS. We put up a team there, and it is our fastest growing geography as well. And we continue to focus by doing some calibrations around the talent, which will be leading these our initiative and foray into growing the US market. New customer wins. We've just mentioned a few here. We've added some large customers in the last 12 to 18 months. Just to name a few, Fashion Nova, which is a fast fashion company growing very rapidly in the US. We've added them and started doing business with them in the last financial year as well. Target, one of the really big retailers out of US, signed up with us. It's taken us about 12 months to do the necessary onboarding that the Target compliance requires. But happy to report that in the last quarter of the last fiscal, we did a small test order with them. All is well, and we expect to do much more business with Target this year and the years to come. Red Tape, Home Depot are some of the others that we added as our customers in last year. As part of our manufacturing operations, you all know that while we are an asset-light platform, but PDS has invested in a few manufacturing facilities as well, largely to showcase to the world that we understand manufacturing as good as the manufacturing-led export companies, and that gets us a seat on the table as far as a lot of large retailers are concerned who make this as a prerequisite to do business with them. So in line with this, we were noticing in the last 2-3 years a lot of shift is happening from let's say the likes of China. There's a China plus one playing out in the market. We know that countries like Bangladesh, which are large in apparel exports, have their own internal strife going on. And just to de-risk our business model, we thought that it's important that we invest in a small way in manufacturing in India as well, because India should be a big beneficiary out of the shift that is happening across the world as far as sourcing is concerned. And we thought that we should have a manufacturer on our platform in India to showcase that we understand the nuances of manufacturing in India, and hence onboard customers who want to increasingly source more from India. And a lot of our large customers, whether it's a Walmart or a Target or Primark, they're all looking at increasing their sourcing from India in a big way. So So I think we are very beautifully positioned with this acquisition. We took a 55% stake in this company, and we should be able to, on the back of this company, earn and secure a lot of design-led sourcing business, which is better and better. Successful QIP. Last year, we thought that given the opportunity in the market and our balance sheet structure, we felt the need that we should bolster it, and we went out to the market and raised about $51 million. This will be utilized both for inorganic growth opportunities as well as I said, bolstering our balance sheet and furthering our growth or fast forwarding our growth as far as our existing business is concerned. All of this said, we all know that last 12-15 months have been extremely volatile. Whatever could go wrong or challenge that could be thrown in the way of a business has been there, whether it's the geopolitical crisis or we all know in our neighboring country, Bangladesh, what happened. There are wars going on. The Western economies are barely keeping their head above water, be it inflation, be it the highest interest rates, growth in their retail market. So there are considerable headwinds that our businesses have been facing. And the next few slides, I would just like to run you through how we are ensuring that in spite of all these challenges, PDS continues to grow, and we continue to be nimble-footed and quickly react to these changes to our advantage. So this slide basically talks about four pillars on which we are working. One is recalibration of our new verticals. New verticals are basically businesses that we have added to our platform in the last 3 years. So we thought there is some need to recalibrate those to fast forward growth and also to enhance profitability and increase cash flow. New Lobster is our Ted Baker business. I'll cover this briefly. Steve, our colleague and CEO of Ted Baker business, is here, so he'll talk to you in detail about what that business went through and how he along with his team are ensuring that the business is back on track and delivers a healthy result this year. Reorganize existing verticals. PDS is a federation of entrepreneurs. It has several subsidiaries and verticals. We thought that there is an opportunity and a need to reorganize our existing verticals as well. Again, the underlying is to grow profitably over the next 3 to 5 years. And last but not the least, driving capital allocation and resource optimization. While we've raised money, strengthened our balance sheet, but this continues to be the most precious resource, and we are very mindful that we should deploy it in a way that it delivers optimum results for all our stakeholders. So a little bit around recalibration of new verticals. As you know, we keep mentioning this and showing very transparently in our quarterly calls, as well as what I mentioned a few minutes ago. We invest through our P&L, right? For me, for PDS, growth in platform means largely investment in people and ancillary expenses around that. I don't have the luxury to capitalize those. That would be very aggressive accounting. I think we are, as far as a company is concerned, cautious and conservative and adopt the best governance practices, and in line with that, we expense this off in our P&L. So while the expense happens upfront, the results come in 24 to 36 months at times, a little bit beyond that as well, depending on market conditions. So if you see, there is a line here, investments in new verticals through P&L, which is close to 162 crores in FY25 and 103 crores in FY24. So effectively, we've invested about 270 crores in the last 2 years in growth of our platform, in onboarding new entrepreneurs, new businesses, and also ensuring that the promise of the platform is there and it keeps growing over a period of time, and we harness the opportunity in the market as well. However, that said, there is a very important thing that we have also focused on and identified that while our top line growth is coming, like Palak mentioned, if we have to achieve the 555, maybe we could do it in 2 years. But I think what is more important is that we focus on our profitability and ensure that our profitability grows at the same pace and is in line with our aspiration of 555. So in line with that, these are just numbers here. If what we are trying to say here is that if we had not invested through our P&L, our margins, be it EBITDA or PAT, would have been, pretty significant as far as what they look like on reported numbers. And in line with this, I think we have in the last 2 years made significant investments, and one of the things is going forward that we will slow down these investments in the current financial year by about 30-35%, and that is something which should directly accrue to my bottom line. So that's one of the measures of how we are addressing and ensuring that our profitability keeps track of our 555 aspiration and grows in line with the top line growth that we are witnessing. Reorganize existing verticals is the other pillar that we are focusing on. Our top 10 verticals did about $1.1 billion of revenue, and their PBT was about $59 million. Here again, we have done a deep dive into each and every vertical, our business, keeping in mind the next 3 to 5 years, and we felt that there is a lot of juice in the system to drive better operating efficiency, cost optimization to improve profitability. We have hired BCG, one of the top pedigree consulting firms, to help us, look at our P&L, both COGS and OPEX, and tell us, how we can do better. To start with, the top 3 verticals in PDS, when I say top 3, it's top 3 by size, are under this project, and the initial findings are pretty encouraging. The whole idea is to get in the best practices, get that outside-in view from a BCG, and ensure that we always remain lean and productive as far as our operations is concerned. We are also, as part of this effort, evaluating the tail. What do we mean by tail? As I said, over a period of time, we have really grown as far as the number of verticals and subsidiaries are concerned, and not all do well. Some, plateau at a point of time. Some find it difficult to live up to the business plan they have given, and we are, closely evaluating. Have bucketed all our subsidiaries into different categories, and a few we have decided to merge with businesses which are doing well. And then our colleague here, Rajneesh, who heads Crayons, which is one of our most profitable businesses, has agreed to run the operations, or 2 of our smaller verticals are now with Rajneesh, and we're pretty hopeful that given his experience and the way he runs his business, because the client base is there, he should be able to turn these around, and he's done it in the past as well. One of the verticals that he looks after, Scope, has been a good turnaround story in the last 3 years, and I think time has come where we allocate these companies to the right person, and as part of that, cleaning up the tail to ensure that our capital gives the best kind of return. We are taking these measures. Reorganization of profitability, while BCG's is looking after or doing this project for 3 entities, but across the group there is a very heightened sense of review, a drive that top line growth is good, but what we need is laser sharp focus, enhanced focus on profitability, and we're taking measures across our verticals to ensure that we do better there. Next slide is on New Lobster. New Lobster is our Ted Baker business. I won't spend too much time here because Steve is here to talk about Ted Baker in detail. But just a few numbers here. The first year of operations, We did about $63 million in 10 Baker. It was profitable. We did a PAT of about $2.5 million. And this was not a full financial year. It was about 9 months, 10 months. Then, it hit a air pocket. There were a lot of challenges that came in this business, and which resulted in a pretty tricky situation as far as the brand was concerned, and it ended up being a loss year for us. And also the working capital, moved up significantly in the form of some stuck inventory and receivables. But that said, I think Steve and his team have done a fantastic job, and they are turning around the business, and we are pretty confident that this will be FY26 will be a profitable year for 10 Baker. Driving capital and allocation and resource optimization. Now, as I said, working capital is our main raw material. We have the best of banks in Hong Kong and Dubai supporting us with working capital. We have close to $540 million of working capital lines, and we ensure that we have enough of this raw material to take care of our growth and future requirements. However, we've seen, given the vagaries of business, the way the environment has been in the last couple of years, we've seen an expansion in balance sheet, expansion in working capital, and which has adversely impacted the operating cash flow. That said, we have identified the reasons why this happened and are proactively taking measures to ensure that we pull our net working capital days down to single digits. There's a plan in place vertical-wise, and then me and my team keep talking to all the CFOs and financial controllers of different entities, giving them data, discussing with them how do we pull this back as far as net working capital days and hence the amount of working capital is concerned. Similarly, operating cash flows, again, squeezing working capital will help us here. As I said, I've spoken about driving profitability. There is a sharp focus there. Also, incremental investments, we've decided we'll go slow. What do I mean by incremental investments is the number of entities or entrepreneurs that we onboard to our platform. We are deliberately going slow. While the opportunity is there in the market, with tons of opportunities, but we think that we have enough on our plate. We need to correct that, enhance profitability, and then again refocus. But that said, if there are any good opportunities that come our way, maybe a couple this year, we will surely look at them positively. PDS Ventures, Palak spoke about the soft power it gives us. We have a decent portfolio of new innovative ideas or companies with new innovative ideas that we have invested in, which are generally around the apparel ecosystem. We, for this financial year at least, have decided that we will only invest wherever there is a committed amount and not look much at incremental investments in this area. A little bit about cost optimization. So this is basically the BCG project. It's about a 10-11 month project, of which we have done about 5 months, and it looks very promising. Just to explain the bar charts here, if our total, let's say, expense base or the baseline across these 3 verticals is 100, what BCG has covered till now in 5 months is about 44% of that base, and they are suggesting to us that there is an opportunity to deliver close to 5% of the baseline, which is 100, as cost optimization or opportunities to make ourselves leaner and expense to get converted into profit. What is under execution is about 1.5% of that. As we progress, these numbers should get better, and in a full financial year, we think that this should very conservatively add about closer to $10 million to our bottom line in a full financial year. So this is the last slide for me. It basically talks about what is the short term looking like. Given given the state of the world today, the number of challenges, there's never a dull quarter for us. 3 months back, 2 months back, we all knew what happened in the form of duties imposed by the US government. We are still grappling with those while a lot of dust has settled, but it does disrupt the industry, it does disrupt the key players, be it the supply chain, be it the customers, and forces us to recalibrate, rethink our course and accordingly play the future the way things are. So we think that as far as the top and bottom line growth is concerned, very conservatively, it should be mid-teens. While as a CFO, I think I get paid to be conservative, and we are designed to be conservative. But I think this is a very conservative number. We should be able to surpass this comfortably, and as quarters progress, as we see closely monitor our order book and engage with our customers, I think we are very confident that we will deliver more than what we are showing here. Q1 particularly is expected to be a bit soft as far as our bottom line is concerned, and we are closely monitoring that situation. It gets a little bit aggravated by the fact that Bangladesh is our main sourcing country. It's a large sourcing country for us. The Eid festival, which that country shuts for almost 2 weeks every Eid. Both the Eids have happened in the same quarter, so that impacts our operations a little bit. But like I said, overall, for the full financial year, I think it's looking good for us. We should deliver impressive growth both in top and bottom line. Cost optimization initiatives, like I mentioned, both through BCG and at the platform level, are being implemented, and we should see benefits of that accruing in our P&L from H2. On the platform, we have taken initiatives to optimize costs. Some of that will start flowing in H1, but large part of it will come in H2. As I said, while short-term challenges are there, which are there in any industry, any business, but as far as the medium and long term is concerned, I think this is a great place to be. There is tons of opportunity in this industry, and I guess with the support of all our verticals, all our key stakeholders like banks and yourselves, I think we should be able to deliver on our promise and aspiration. Thank you. So I think Rajneesh, I invite my colleague Rajneesh to take us through his presentation as well.
So, I'm CEO and founder of Crayons. First of all, a lot of anticipation has been kind of growing on my percentage that I bring to the bottom line. Of course, a lot of hard work has gone into it. So just to I just give you a little brief about myself. So I've been in the apparel trade for close to about 30 years now. And 15 years have been with PDS. I joined them in 2010. Prior to joining PDS, I was with 3 other companies. 15 years I worked for them. And I thought somewhere down the line there were a lot of these boxes that remained unchecked as an employee. And when I thought of creating my own company, I thought, let me check these boxes. The fact that I was able to create this company, Crayons, and check all these boxes was only because of the PDS platform and the support that I received from Pawan. So it's a company that we created. We take a lot of pride in it. And before I do my presentation, there's a short AV that I'd like you guys to see.
Since 2010, Crayon Sourcing has been delivering comprehensive supply chain solutions to the global fashion and retail industry. Combining cutting-edge technology with time-honored techniques in garment design, manufacturing, sourcing, and brand management, we transform creative visions into reality. Fueled by innovation and driven by a commitment to excellence, we collaborate with world-leading brands to bring trend-setting designs to life. Our extensive network of over 50 certified advanced manufacturing partners ensures we source sustainably and ethically at every step. With an entrepreneurial mindset that drives us and our values that guide us, we put people at the heart of everything we do. Our customers, employees, and the communities we serve. People are our greatest asset. Design, create, get inspired with crayons. Discover how we can elevate your brand at www.crayonsourcing.com.
Yeah, so this is what we created in 15 years. So currently we do close to about 100 million in terms of top line. We have about 150 employees who work for us, and primarily 4 offices. So I would say Bangladesh is our biggest office where we employ most of the people, and then we have a smaller office in India. We recently set up an office in Mexico, and we are about to set up another office in Brazil. One of the key strengths for us is we are a bottom line driven business. For us, we do look at sale of 100 million. It sounds good, but for us, what sounds even better is 7% bottom line. So our benchmark is very high, and this is what we actually want to trend. So we could falter a little bit on our top line, but never on our bottom line. In terms of organization structure, we've got 2 companies. So Crayon Sourcing Company is what I founded and I created myself. Scope was a company which was given to me about 3 years back. First, to talk of Scope, so this company was given to me 3 years back when the company was doing about $11 million worth of turnover and about $100,000 worth of profit. So it was very slim profit. This year, 3 years later, we are about 18 million in terms of top line, and we are about 550K in terms of profit. So about 5x growth in about 3 years. As far as Crayon would go, again, like I said, this is a company that I created. So our model is very entrepreneurial. So we have marketing and sales vertical. These are the people who go and book business, and we have sourcing verticals who execute. At the same time, we've just put in a common platform of design, product development, quality assurance, which basically feeds both the companies. Our customer footprint, we of course majorly a lot into the US, but we have customer bases all across the globe, as you can see. So in terms of our global presence in regions, US is our biggest clientele. We have close to about 65% we supply into US, and then rest, balance 35, equally I would say between India, South Africa, EU. Latin America is going to be big for us, and GCC countries. Again, in terms of strategic customer partnerships, we have majorly with Costco, TJ Maxx, Sam's Club. We are a lot into value chain and club businesses. In India, we supply to almost all the retailers, and so is with South Africa, and also going now into Latin America. In terms of product categories, mainstream apparel, we do everything from menswear, t-shirts, sweats, shirts. Similarly for women's wear, anything from tops, bottoms, denims, nightwear. And same goes for kids. And we also started our home this year. It's gaining good traction because most of our customers are also doing home. So we've launched our home this year, and I think it's showing good results. We are into brand licensing. We've taken a curated license for swimwear for a brand called Taylor Vintage in the US. Brand is like a mid-scale brand which sells into likes of Costco, Nordstrom, and TJ Maxx as well. So we've already done our couple of shipments. And so this is something that we feel that we want to do more licensing activities. This is our first LDP operation into US, and we feel we could do similar more in near future. Just to give you a 5-year like our trajectory, how we've moved. So from 2010 when we got initiated, I think the first 50 million we were to bring it, say about in 10 years time in 2020. Another 50 came in about another 5 years, and I feel by 2030 we should be able to gain at least 3x growth. Quite possible now that we have a launch pad of about 100 million plus. If I was to look at just the graph when we were creating, I felt that there was an inflection point after every 5 years, and I feel the inflection point for next 5 years could be far greater, which could take us to about 300 million. Like I said, my focus is not 300 million. My focus is 20 million bottom line. That's the focus. If I was to look at 7%. So even if I was to do 250 and I was to do 8.5 in terms of bottom line, I'm still secure. Currently, we are making about 6.75 of our strict scope in perspective. So for me, numbers are not top line that I'm looking at. I'm just looking at bottom line and the percentage that we need to bring to the business. So how do we do this? It's easier said than done. Then from 100 to 300, how are you going to go? So we've kind of mapped it out that we need to launch ourselves into more different segments and different markets. So like I said, we opened our office in Mexico. Next one is Brazil. We are already talking to somebody for our offices in South Korea and Japan. Now, mind you, these offices, even though we are opening, they're very lean offices, headed by just one person who will drive the business for us, and all the back-end work gets done in low-cost countries like Bangladesh and India. Product categories, again, we need to diversify from mainstream apparel. We say we do uniforms, we do leather, home furnishing. So all we have to do is we have to just settle separate verticals. People who have already been doing this, get these vertical heads to come and use our platform and start these businesses. PDS Synergy, again, a huge, big platform. How do we use it in terms of sourcing? A lot of places I don't need to have set my own sourcing offices. They're already there. We just need to synergize. Speed to market model, like we said, it's already there. We started communicating with one of the verticals within PDS who's doing it. We are digitizing our supply chain where everything happens from SAP, it's extracted, and the vendors can go accept the PO, the payments are done. So everything is done through Weave. We are actually co-creating Conquer. It's like a digital platform for queue activity, which once done in about a month's time can be used by all the other PDS verticals as well. Again, in terms of segments, like we said, we want to get into more into licenses business, like I was telling you, but curated license, something that we have a strength in, where we feel more comfortable doing. We also want to get into luxury. Somewhere down the line, if you look at South Korea and Japan, this is where our market is looking at a little luxury segment, vis-a-vis what we are currently doing, which is more value chain and mid segment right now. D2C, we have a brand called Cult. It's a digital, brand. We want to do some digital limited collections. We are looking for a vertical head who can do this for us, and hopefully we should do it, if not later this year, maybe next. M&A is another thing, so all these 15 years, we've not had any acquisitions that we've done. We've saved off enough money, and I think this is time that we now do it. I think this year, the bottom line we've got to the business is close to about 6.7 million. And then I think we're parking some money on the side saying that, why don't we acquire some businesses to also get us some acquired growth. As far as mergers would go, we're getting a few accounts which are not doing very well, which kind of get merged with us. They also give us a little bit of push. So this is how it is. I said 100 to 300, next 5 years, 3x growth. Keep 300 aside, as long as we're doing 20 billion is what our target would be. So, there's so many businesses, like 40 businesses just within PDS, which do what we do. There's so many other trading models which do. So, what is the comparative edge that we have? I think this is what it is. I think it's a low cost and an agile model. So we having this discussion with a few people today that, let's just say in terms of design, we have maybe one expat designer and we have maybe 15 local designers sitting in Bangladesh, who probably my entire design team is costing me less than maybe one designer based in UK. So that is how lean we are. There is no fat, all right? So I think we are it's a low cost model and we are very agile. I mean, the teams are, if people are delivering goods in 100 days, we deliver in 80-85 days. So it's a very agile platform. Again, 4 pillars, global sourcing, logistics. Nearly 70% of the goods that we ship to the US are DDP. So we deliver duty paid. So we have a TPL as a group partner which we use to do that, which is an added service to the customer. Like I talked about design, again very lean structure and quality control. Now, if this is my comparative edge, which looks like, I can tell you this is fueled by a very high performance culture. This culture can only work where it's driven actually by entrepreneurship and profit sharing. If we don't have, so like I said, all my businesses are vertical driven. They're verticals who basically running P&L. We give them total transparency of the profits that they make in the business. I mean, I'm probably the only company in 40 companies that shows its profits to its team every quarter, because that's where they get their targets during budget. And then we said, all right, so this is the profit that you need to get. As it is doing that, we give you a profit share. So each and every one. And one more thing, the profit share does not go just to the top, first line, second line. No, it goes till the peon. It goes to maybe a PD tailor who's making. So even this year, all these guys who, and even at Lowe's, are making close to about 5 salaries as bonuses, which we do. So incentivization is key to our business. And like I said, I've always told Palak that, while we are, PDS is a big structure, at core and heart of our teams that are working in these low cost centers. We want to incentivize and make sure that make them like a little bit more richer and more have a much more sustainable future. That's it for me. Thank you.
My story is quite different to some of the stories you've heard so far. This week marks the 2nd year anniversary of when PDS signed the license with our friends at Authentic Brands to be the global design source and manufacturing house for the Ted Baker brand. I'm going to share with you over the next 10 minutes the chronological timeline from signing to date. Hopefully the takeaway from this will be that no matter what life throws at you, if you have a great brand, you believe in great products, you have the backing of support of a strong parent company, and you have great partners like Authentic Brands, then anything is possible. So, Authentic Brands bought the Ted Baker brand in October 22. In January of 23, they signed their first license with a company called OSL to take the USA business. In June 23, ourselves, PDS, bought the New Lobster business to become the design source and manufacturer house globally for the brand. And a Dutch retail partner called ARC took the license to run the UK and the EU business. Our license and role in the global Ted Baker business was split basically into 3 categories, and which delivered 3 revenue streams. The first was a buying agency model. We would supply the main retail partners on an FOB plus basis. The partners would pay the factories directly, and we would invoice them. Sorry, one missed the slide. There we go. Excuse me. Yeah. The second part was similar to the agency, where we would supply all the global franchise partners on an FOB plus basis. The third and more traditional part would we become the exclusive UK and EU wholesale partner, where we would sell the product to the partners, buy direct from the manufacturers, and work on a traditional wholesale margin. For context, The brand, as it closed its financial year at the end of January 23, had global retail sales of $650 million. Our revenue, the buying agency would deliver 40% of that revenue to us. Post-acquisition. When we signed, on the day of signing, on the day of signing, the order book was already in place for the Q3 and Q4 seasons. They were booked with the manufacturers, the purchase orders had been placed by the holding company, and payment would be made directly from them. We would then pay the holding company. As early as October 23, we started to experience some issues with the main license partner, unfortunately paying manufacturers late and causing product delays. In November of that year, Authentic helped support the business by securing and helping them secure an asset-backed loan in order to clear down some of the manufacturer debts. January, the retail partner ARC were removed as a licensee as they defaulted on their payments to Authentic Brands. An independent CEO was appointed and all partners were reporting severe decline in sales due to the serious delays in product. In January, we had our first showroom collection for autumn-winter, and it was extremely well received despite the market challenges, and all majors were placing good quantities. ARC, the partner, actually placed good quantities on behalf, and this was signed off by the independent CEO and the senior team. March, the problem started. None was put into administration. This impacted our business, the brand, and all the manufacturing partners. Manufacturers were not paid by Noddle for the Q2 stock, and the Q3 order books they had taken, they had fabrics, trims, with no manufacturing capacity. We moved into damage limitation mode. We met with all the manufacturers to try and save as much as the Q3 products as we could. We managed at this stage to maintain 85% of the Q3 range and worked and supported the manufacturers. There was obviously concerns raised by the UK and EU wholesale customers around the negative press and publicity caused by the ongoing administration process, and then the store closures. At this time, all the international partners were not affected and were still witnessing extremely strong sales. In April, the US operator OSL filed for Chapter 15 in the Canadian courts. This was a huge shock to us, OSL, to ABG, and all of the partners. The manufacturers are in production and the product is finished for the autumn styles. Over 50% of their volumes have now been cancelled. At this stage, we're not even a year old. We then have to move into rescue mode. We have to save as many manufacturers' relationships as we can. We work with the manufacturers and with Henry and the Authentic team, who introduced TK and other strong candidates to help the manufacturers clear their excess inventory. We had no retail partners were assigned to the UK, and the stores were already closing down. All the standalone stores in the US are now closed and no retail partner is found. We had to focus our energies on OPEX reduction. We removed all the marketing and store support team, and we had to put the whole business into a consultation period when eventually we reduced the headcount from 135 to 84. We removed all non-essential spend, including travel and marketing. As we hit August, unfortunately no retail operator was found and all physical UK and EU stores closed. This had a massive detrimental effect on the autumn-winter 24 wholesale business, as the stock in all of the retail stores was at 80% discount. Authentic in this month did manage to find a partner for the website and announced United Legwear as the US partner who would run tedbaker.com and manage the Bloomingdale concessions. In September, the same partner was then announced to run the tedbaker.com UK and EU website. We managed at this stage to deliver a minimum Q4 range to them in order to keep some continuity and newness flowing into the brand. We breathe, we have Christmas, and we start to turn the corner. In January through to March, we deliver our spring-summer ranges to all of our partners. There were some delays caused by the previous administration, but in general, products were with us partners on time and sales started to come through. The orders were low, probably at around 60% of the original budget, obviously due to the uncertainty around the brand following the store closures and the administration. So where are we now? We're seeing green shoots. Next, John Lewis, Albertine, a South African partner, and Bloomingdale's are all showing good full price sales. What it showed us is the Ted Baker brand could be fairly bulletproof. It has survived the administration from an end customer's perspective and still remains extremely desirable. We have put in place a completely new wholesale and franchise sales and accounting to deliver the level of service required, as we are now solely a wholesale business. Our Q1 and Q2 spring-summer ranges have been extremely well received by the customer. We've also needed to look at our retail price architecture and landscape, and we have had to reshape the retail price and the product offering to represent the landscape with our retail stores. We've entered into a strategic supply partnership with Fraser Group, supported by Henry and the Authentic team, where we will deliver them an own brand margin, and they will give us, Ted Baker, the physical footage in the House of Fraser stores from autumn-winter 25 onwards. We've established great relationships with TK Maxx and Zalando Lounge, who have helped us clear through the excess inventory and have agreed a strong SMU program with us from spring-summer 26 onwards. Work in progress. We're analysing our customer requirements and range shape. We're reducing the number of options we design for each phase by 25% to reflect life with our retail stores. This has meant we can then look at restructuring our buying and design team and reduce our OPEX by a further $1 million. Manufacturing confidence is coming back. We're currently working on reduced terms with them, but which is creating pressure on our cash flow, or should I say Raoul's cash flow. But we are moving forward with them, and hopefully terms will come back. The financials at a glance, I think they are very similar to what Raoul previously showed. What it does show is that this year we're showing to grow revenue to $70+ million. We're going to be delivering EBITDA of over $2 million and a PAT of just under $1 million. Our main focus this year is a business reset. We have reduced our OPEX to date from inception by $8.5 million. We're going to focus on re-establishing brand loyalty and trust with our end consumer. We're rebuilding relationships with our key accounts and distribution partners. We're working closely with our international franchise partners to ensure we still understand their regional needs. We continue to invest in ranges and innovation through our product ranges. We'll re-establish the Ted Baker footwear business and we'll bring this business back to profitability.
Is that it?
Thank you. And just from here, Henry and the team, thank you for your support.
And everyone, it was just by coincidence I happened to be planning a trip to India, introducing our new head of India, Sanjeev Mehta, who joined us recently. And so I wanted to take an opportunity to say hello to everyone and fill in some of the background on Authentic. For those of you who don't know us, we're the largest owner of sports, lifestyle, and entertainment intellectual property in the world. We generate about $32 billion in GMV sales across our portfolio of over 50 brands. 1,700 partners doing business in 150 countries. An asset-light model that works with best-in-class licensees, both retail, wholesale, mono-brand, and multi-brand retail in addition to e-commerce stores. Regarding Ted Baker, we certainly learned a lot through the process. One of the main reasons we're still here today speaking about Ted Baker and strong future prospects is because PDS never compromised the design or the sourcing of our products. It is well designed, high quality merchandise that has maintained a very strong consumer demand as we've transitioned through a very necessary reorganization of the infrastructure and the model. In our business, we buy great brands. Oftentimes we buy great brands in a troubled situation, and Ted Baker was certainly that. The infrastructure, the tech stack, the stores were not efficient, and hindsight being 2020, we would probably have taken a different look at the approach of what had existed as we were embarking on the licensing and transition from the former operating company to our new global operating partners. Right now, what we are seeing is, as Steve said, a good consumer demand for a fairly bulletproof brand that is much sought after and desired. Through PDS's infrastructure, we maintain not only quality and design, but we are now seeing growth in many of the global markets, such as India, Middle East, South Africa, and even the US now is starting to show a lot of growth, and then Southeast Asia and the Far East. So that sort of brings us to where we are today. With respect to the authentic relationship with PDS, I've known Palak and the team for over 15 years. And at Authentic, we would want to do more with PDS based on their integrity, their commitment to excellence. And I think that, an opportunity for me to stand here today and say, yes, it was beyond a difficult transition to get to this point. Steve efforts, the efforts of New Lobster, Palak and the team have really supported the brand, and now we're looking at new opportunities to grow it. I spend a lot of my time based out of the London office meeting with the biggest retailers in EMEA and India. The demand is clearly there now that the design and the supply chain are slowly reestablishing itself. We are seeing more opportunities throughout Europe. I've met with some of the largest chains one-on-one, top to top, and we are, based on the results that we're seeing with the merchandise, the re-emphasis on marketing, we are seeing new opportunities to grow the business. And there have been some very, very strong results. Companies like Next and KMI are seeing also great returns on TED. So it's looking good for the future. A very difficult past, but that sort of brings us to where we are today. And if anyone has any questions, I'd be happy to answer them. Oh, don't be shy. I came all the way here without a luggage. But we do have a Brooks Brothers store down the street, so they outfitted me today. All right. Well, yes, go ahead.
So how much more business can you do with PDS over the next 5 years?
How much more business can we do with PDS? A lot more. Authentic is an acquirer of brands, and the door is wide open for PDS. They've showed us their commitment to supporting a brand in a difficult situation, and I think we owe respect to PDS by doing more with them and growing both our companies together. We are committed to that. Yes.
What is the larger GMV of your vendor?
I'm sorry?
What is the largest vendor GMV contribution from your side out of 32 billion? Or maybe top 3?
Vendor or retailer?
Your supply partner. So you mentioned you work with the 170 plus partner, including PDS and likes of that.
Yeah, United Legwear in the United States and Europe handling the e-commerce. Next is another major partner. Those would be the larger ones that we're seeing around the world.
How large are them? Is there close to $1 billion, $2 billion for you?
I'm sorry?
How large are they are in terms of handling the GMV for you?
Well, we don't talk in terms of their actual GMVs. Next had an unbelievable year last year in Ted Baker, almost a 50% growth year over year, and they're expecting another double-digit growth. United Legwear, which relaunched the website going into fall with a very narrow assortment. We're seeing now week-on-week increases as the new merchandise is coming in. Last week they had a 55% increase over the week before, so the sequential increases on the e-commerce business, now that the product is there, now that the marketing is kicked in and we've caught up on that, we expect to have a very strong fall into Christmas season, both in US and Canada and in Western Europe, which are the two of the major markets. As far as India, the GCC, South Africa, they remained largely unaffected through the transition, and they are seeing double-digit growth, 10, 12, 14% year-on-year growth on the brand. That speaks to the brand and the quality of the product.
All the portfolio of the brands which you own, large parties are outsourcing and sourcing, or you do direct sourcing also?
It's a combination. When it comes to a brand like Reebok, we do have an RDG, Reebok Design Group, similar to what we have with TED Design Group. Some of our partners have the ability to manufacture some products, but when it comes to brands like Reebok, largely the global supply chain on footwear, not 100%, but well into the 90 percentile is controlled through a central design hub. It's a model we really believe in order to have global expansion of our brands and to maintain product consistency, product quality. And it is better. It does allow us to scale our brands by having partners such as PDS or the RDG partner to have a centralized source. It's faster, easier for our operating partners to buy into it. They have an opportunity to communicate their special needs for their market. And we found that companies like PDS are able to work with agility in developing products specific to the market needs in addition to addressing the global requirements of the brand. Speak slow and loud, my hearing is shot apparently.
I just wanted to ask, what are the values that PDS brings to the table for ABG Group, and do you have any other business interest in India?
Well, I think as you saw in the presentations, PDS has 5 critical areas that they focus on: design-led sourcing, sourcing as a service, category management, deep knowledge on brands, and expansive manufacturing abilities. Those 5 critical areas support our brands, and that's what we tapped into. That's, fortunately I met Pallet, as I mentioned before I joined Authentic a few years ago, so I knew what they were bringing to the table. What we saw through this transition is their stickiness in supporting the brand. They never quit. They had a lot of long nights and a lot of sleepless nights, but they doubled down on it. And when you have a partner who does that in messy situations, you want to double down on them and work with them and work through it. Their commitment to us was unparalleled. They had it tough and they never quit. In terms of our India business, we have many of our brands in our portfolio are licensed here. Obviously Reebok, Brooks Brothers, we're here working on our champion plans. Arrow, which is a very big brand in India, are all part of our portfolio. Nautica, Postal, quite a number of brands that are available in this market. And we've recently committed to a lead here. We will be opening an office later this fall. We anticipate close to 20 authentic people developing India into the future. We believe it's one of the biggest opportunities for us. And it's not just about bringing Western brands into India, it's about bringing our concept, our way of doing business into India. So our partnerships with people like David Beckham and Shaquille O'Neal, in addition to what we do in the sport, lifestyle, and entertainment brands, that methodology is what we're excited about developing into this market.
Hi, thank you for the presentation. So the question is that as a owner of so many IP of brands, what are the 2 or 3 things when you look for in a partner, when you license it out to them in terms of KPI, in terms of the outcome? If you can talk more about that.
Well, It's a very good question. We want partners that are going to share our beliefs and our values in terms of investing in the brands. Product leads in all cases. That's consistent. I don't think anyone who's in this room who manufactures or sells products can get away with anything but great product. That defines it. PDS certainly, with the Ted Baker Design Group, brought in an infrastructure, carried over an infrastructure, and was able to design and develop great product with a fully compliant supply chain. In today's viral world, if you don't have that, you're in deep trouble. So while the media may have taken it out on all of us over the stores, we knew to let it flow and pass because we were going to allow the product to speak for itself and allow the consumers to keep tapping into that. As each week and each month progresses, retailers are getting more comfortable with TED. They're seeing it as not gone away. And that was part of the analysis that we had with PDS. They were able to stick through it, a little support from us, a little bit of luck, some changes to the infrastructure with a long-term view, and that was all the kind of criteria that we want when we onboard, one of our partners. Right now, Authentic is fortunate. We have 1,700 business partners around the world, and PDS is certainly at the top of the pyramid.
Yeah. Can you give us a sense of the top partners among that 1,700 partners you just spoke about? And where does PDS stand? 1,700, even if you say they're in top 10, it's 170 kind of number. If they're in top 20, 340. So where does PDS currently stand, and what kind of journey can we expect? Given that you have traveled so far, certainly we expect an upward journey. So.
Well, I think, I'm not going to go into specifics who our partners are in each market because, that's very closely held to us. We have partners that generate well over $1 billion in wholesale sales in various markets like the United States. And we have partners in Central and Eastern Europe today that are fast approaching $1 billion that are doing both retail and wholesale. There's no question that the right combination of brand acquisitions and continued growth with a brand like Ted Baker, we could do 4x, 5x the business that we're doing with PDS for you.
Thank you. The second question about the India operations. You mentioned there could be a 20-member team in here in due course. Given that you have also the option of working with PDS, what benefit do you think your own team will bring in that you want to hire 20 people?
Well, our team, remember, we manage multiple of roles. We have to market our brands, we have to acquire the brands, we have to identify operating partners. PDS starts largely as a solid design and manufacturing base. As they continue to develop their infrastructure where they do more wholesale, we've had some conversations about PDS branching into retail. They're not ready for that right now. That's a very important part of our consideration when we onboard a new partner. However, many of our partners don't have the manufacturing prowess. They may have distribution capabilities, they may have wholesale capabilities. We believe that by partnering our local operating partners with a strong supply chain, that's the magic that we're looking for.
Thank you.
And we are just
throwing a softball if you can ask that question.
So I just want to add, I think we've gone through a bump in Ted Baker with the best intent from ADG, Henry's, support, Steve's, resilience. We are coming out of it. If that bump did not come, brand business of PDS with ADG acquiring more brands, you would have probably signed more brands. There are other deals like you talked about Champion, you talked about Dockers. You would have ended up doing many more of them. We just wanted to stabilize, prove the model next 12 months. Once we pass the stabilizing journey, it's a highly profitable business model, both from the IT owner perspective, but also brand operator perspective. So as things stabilize, we have a very strong relationship with ADG, and we feel we can partner with them multiple geographies, and PDS has the capability to design, manufacture, source, and very strong wholesale team that we developed as well.
And we do have several licenses
Yes,
with divisions like Poetic
Yes.
and Techno Design, so we are already doing more with various divisions within PDS.
Yeah, like we have got Prince license, we're talking about, we've got Accessory, Porsche, Lucky, Hunter. So yeah, so I think there's a very close relationship between both companies, and we can do much more together in a more serious way.
Thank you, Andy.
Thank
you
you.
so much.
People always ask me how I got from the music business to the sourcing industry. And it's simple. Retail is entertainment. Products have to be great, they've got to be sexy, they've got to be entertaining, they've got to grab your imagination, and the retail environment, like at Apple, has to be impulsive. It's retail 101, online and offline. It's the same as the music business, same as entertainment. It's all one thing. And we're fighting for people's time. You have a nanosecond to grab their attention. So we either have to provide a great product, a great brand as Ted Baker, or a great service. You have to surprise and delight like Taylor Swift, or like Pop Mart and Labubu. 25 billion right now, Pop Mart. That's entertainment. So welcome to the evening slot. I'm the last speaker today. My name is Eric Bedell. Thank you very much for your time, and thank you for our team for putting this on. I started my career in the music business, and I was living in Hong Kong. I was the international vice president of marketing for brands like Mariah Carey, Bon Jovi. I even came to India and worked with Asha Bhosle. And then I got out of the business when I was tired of that lifestyle, and started a company and ended up selling it to Melissa & Doug. Melissa & Doug is a Berkshire Hathaway company. So built my company over 7 years, built distribution in the US, showrooms, salespeople, and ended up selling to Melissa & Doug. At Universal, I brought our team from a 19% market share to a 25% market share in market leading in Asia. And then I joined Lee & Fung. I transitioned from my company into really into sourcing, came back to Hong Kong. And that was when I took a $100 million portfolio GMV with one customer to a $750 million portfolio with a multitude of customers. And that led me to PDS. So Pollock and I met several years back, and I understood that they didn't have a general merchandise or a home division. And I thought, oh, they have about 45 companies at the time. This is a big opportunity. Pollock was also interested in this, in a venture. So we decided that we would start a company. But before I tell you about our company, I need to explain to you the difference between, because we've been throwing around GM, general merchandise, and home. What's the difference? We have a different lingo. We have a different vocabulary in our world, not like the apparel world. General merchandise, commonly known as your commodity items, stuff you find in a supermarket. So it could be anywhere from toys, stationery. It's more of your everyday products, even toilet paper. And homewares or home, it tends to be on the textile side. I think India is very strong in it. It tends to be bedding and bath towels, rugs, throws. So, there's lots of different terms. They even call it something different in the UK than they do in the US. So we went and started Casa Collective, basically a collective of everything under the sun in home and GM. And I brought my team from my previous company, Lee & Fung, some key people with me. And at the time when we launched, we were going to bring our team, we were going to bring factory partners, and we were going to look at being non-China, because we knew that the US market, which was predominantly where my background was from, North America, was bringing the US market. But it was a very challenging period. And at the time, this is in COVID, the US, every Garmento was jumping into the home business. And so you had a situation in the beginning where you had retailers were already stacked with product. Then you had the inventory whiplash. And you had all of these new players into the market. Well, the reality is the homewares business, GM and Home, is a difficult business to be in, and it has so many different products. I'm going to take you on a journey of what GM and Home looks like before I talk about our numbers. So you can see that there's beautiful products. There's knits, there's techniques, glassware, and all of these products were touched every single hour of the day. But people didn't realize it because basically the homewares people who sourced homewares for many years were sort of the quiet ones, and it was fashion, that fashion and apparel that was big in the industry. So COVID really helped kick us into touch, and we became a big highlight. So here's just a journey of all the different products that you live with your life daily, and you can see how much opportunity there is in homewares. Great products in homewares. I didn't even take you through every aisle. I'm sure everyone liked the gin tonic, the gin o'clock. That's coming soon. So at Casa Collective, our core competency is basically developing full private label. So we develop full private label brands and assortments that are on trend. We do design work and we do the sourcing work. We oversee the manufacturing, and we partner with our strategic partners across multiple supply bases. So I'll explain that. And I'm representing today sourcing as a service, because basically what's happened in our business is that sort of revenue stream or that business model has really taken off for us. So it first starts with great team members. And I brought over expertise, world-class expertise. So Ifat used to design for Zara Home. She actually was in apparel, and she said, we should be doing throws at Zara. And they said, go for it, Ifat. So she designed the first collection for Zara Home. She's worked at Target, she's worked for Williams-Sonoma Group. So she's fantastic, she's based in the US. I brought Emily Tam over, who is one of the first people who took American greeting stationery out of America and helped launch the Chinese factories. Emily Sin from Aldi, Ashish from William E. Connor here in India, and William Fong. I have team members from Walmart. Basically, I prioritize hiring the best possible category managers and people with experience from retailers that I know our customers aspire to be. We have approximately 60 team members worldwide right now, and you can see where they're all based. And we have global offices. We have our own offices. A few of them are hubbed within PDS Group properties, and a few of them are separate. Our core services: trend forecasting, private label development, as I mentioned, sourcing and production, compliance and assurance. This is crucial, both quality and ethical, and we lean on the PDS platform for our support in ethical. Visual merchandising and white space. White space is our secret sauce. I'm going to show you that in a moment. And we provide flexible models. So I mentioned that sourcing as a service is our big model, where basically we're an agent on behalf of the customer, and we work with factories, but we also have a supplier model. So you can see our sourcing network. When I launched Casa Collective, I knew we couldn't be China only, because at the time, for the last 10 years, the US, we knew what was coming with Trump. There's anti-China sentiment, and we knew from Trump term 1 that we were going to continue to see these pressures. So we knew that we had to launch with team members outside of China, which has been a competitive advantage for us. But it's also challenging, because if you think back to all those great home products I showed you, think of all the substrates and materials that we have to work with. We work with wood, we work with metal, we work with textiles, we work with glass, we work with paper, we work with stuffed animals. So you can imagine you have to have manufacturing bases across the globe. So from Turkey into Asia. These are all the product categories that we specialize in, And there's probably another sheet I could show you, which is also areas that we could source. It's a very, very wide ranging of products. Our core categories are in home decor. I'm going to show you what we do as far as our process to develop home decor. But seasonal businesses are massive, right, in any retailer, online or offline. And the pet category has been a big growing category. Outdoor, with global warming over the last 5 to 10 years, you're seeing a lot more sunshine, so gardening and outdoor living has been a category that's been growing. And small space living, something that IKEA specializes in. More and more young people are living in smaller apartments. You've got developing nations who have apartments. Those types of products and understanding of the market are crucial. So our development process is really important, and it starts with a white space analysis. I'm not going to walk you through the whole thing, but the white space analysis I want to show you because that's really, I think, our secret sauce. We do white space, and then followed by white space, we do trend development, product development, sourcing, and of course quality. So here's what white space looks like. If Fat and our design team, whether it's her or in the UK, we do a deep analysis of what the competition's doing. It's basic, this isn't brain surgery. But she goes in and analyzes exactly what the customer X, I'm not going to mention right now, who they're looking at. And then she presents this, and this is 1 page out of 30. We take a category and we do a really deep dive into it. This is natural fibers, fashion storage, and you see the opportunities. So what she'll do is she'll basically show them what the other retailers are doing and then talk about the opportunities where she sees simple construction, contemporary rattan. Some of the areas that are starred are the areas that she's really promoting. And this is what you get after the white space. This is the presentation she gives. So all of these products are from factories that we source from, that are qualified, compliant, and with quality management systems. And so after you do your white space, you do a presentation. Here's another white space for pillows and throws. So you have pillows, specialty throws, combo packs, and this is the engagement with the buyers. This is the sort of fairy dust that you can't get anywhere else. We can have top-down engagement, but the bottom-up engagement with the buyers, this is the key. I'm going to walk you through. So we start with our white space. We do our own trend development. This is what we would present on the back of that trend development. So if we're talking about pillows and throws, techniques, what's on trend, very, very important that the buyers trust you and that you bring forward the right product for the right time. And then this would be, so after you take your trend, then we planogram. So this is a basic planogram, and this is our own brand called Casa Eden. All of it's from India. And this is a mixture. So I mentioned in the beginning, our core competency is taking a full product range. So we mix hard and we mix soft goods, right? So you're seeing kitchen textiles with serveware. This is unique. We're not a supplier that you can come into our showroom and just buy off the shelf. We wrap our arms around every customer and give them a boutique service. Again, another trend, and then this would be the response to that trend. So this is where we would go in, telling the buyer, here's the intel you need, and here's our solution for it. Our last trend, Flora. We talk about the materials, the techniques. A lot of times the buyers know this, but they want to know that you know. To be a strategic supplier, they need to know that you get them. So now let's start to head into the numbers. And before I do, when Sanjay, I think Sanjay and I both started around the same time, right? And when Sanjay and I had our first review, we were struggling in the beginning because we had a couple of customers who looked like their financials weren't great, but we were continuing to sort of monitor them. And I always said to Sanjay, I can't tell you who we're going to win with. It's like a portfolio of horses. But I can tell you this, we're going to back the right horse at the right time and take all of our investments and make sure we don't lose the company any money for those U.S. customers who then would eventually file Chapter 11. So Bed Bath, Beyond, and Joann's stores, you see the horses at the back, ended up filing. They were the first 2 customers that we were going to launch Casa collectively. So what did we do? We leveraged the PDS platform, Pollock's long relationships, success other business leaders have had, like Sunny and Anuj, who met last year, you take some of these long-term trusted relationships and they open the door at Asda for us. Asda is the third largest supermarket right now in the UK. They're buying approximately $500 million directly, and we currently have a large 60% of their direct buy in general merchandise. TJ Maxx, #1 global off-price retailer. So we are a strategic global agent. They have their own offices in many markets in the world, but they've also signed CASA to be one of their global agents, which means across all categories, across all production markets, we're a trusted partner. Recently, we've introduced them to Coloc and some of our apparel teams. These are key and developing customers I'm talking about. We're going to our first Walmart meetings next week. I probably don't need to say much about Walmart. Michaels, they're in the same sector, the party and arts and crafts sector that Joanne Stores and Party City, who just filed Chapter 11 in the US. So they're now attracting tons of foot traffic at Michaels, the #1 largest craft and retailer in North America. And then Kohl's. Kohl's is working across many of the PDS platforms. So here's our numbers. You can see we started in October of 2020. It takes usually 18 months to get off the ground at that point. Very challenging with COVID. Getting the attention of some of my key and long-term strategic executives was difficult because they were just worried about how to get product on their shelves. But you can see over time, once we hit FY23, things started to move in the right direction. We onboarded Asda, we had a test, and now you can see what our numbers are in FY 2005. And then we're anticipating that this sort of business, the sourcing as a service business for us, will create a lot more opportunity, and I would see in the next 3 years probably doubling that. Here's the key though, it's not just, the top line looks great, it's big, it came very fast, but really it's the PBT. And you can see where COVID, where we were stuck here in launching in COVID, but as the recovery started, and as we started to be able to get traction with Asda and TJ Maxx, you can see where our profitability came. We were able to achieve profitability for the first time between FY23 and 24. We're cumulatively breaking even this year, and you can see our PBT at 1.9, and it's an 18% PBT to margin percentage. So we see this as we've gotten through the really tough times. We highly respect the customers we have. We like strategic relationships where we can build around them. And our future plans are this: more sourcing as a service. My background at Lee & Fung in managing that large portfolio really taught me how to do that, but also how to infuse design into that model. So it's not just a simple third-party agent. We're actually a strategic supplier that also adds value in design. The US market. So Coloc really wanted me to come on board because we were the white space. We had home and GM, and the US was my background. Obviously, early days struggled with a few accounts, but we see green shoots with TJ, potentially Walmart, Michaels, and others. So the US market is going to be a big focus for us. There's also opportunities in the UK. Online marketplace and social e-com is an area that originally, so if my first 2 years wasn't as slow as they were, that's what we'd be talking about today. That's part of the next 3-year plan. It was part of the original plan as starting year 4. Category expansion. We have some big core businesses which we started up. So for example, electronics, toasters, microwaves, high-risk items that are all done in China. That, for us, is an $80 million business alone, in sourcing as a service. That's a category I never thought we'd start as Casa Collective. We're a design-driven supplier, right? We're sexy. Toasters aren't that sexy, but there's lots of categories within the GM world that you can get into and can drive serious volume and margin. And lastly is leveraging our management team. So with that great growth we saw with Asda, we were also under exclusive contract. They wanted to make sure that if they were going to grow us that big, that we would remain focused on them. As a startup, They were evaluating other players in the market, and they chose us to partner with and grow. So it was a very big deal that they chose us. And it was based on the foundations of trusting PDS, but also seeing the type of talent we have within Casa Collective. So leveraging our management team across more customers is something that we'll be looking into in the next 3-year plan, similar to what you heard from some of the other presentations during our hosts. Thank you, and we have Q&A for all of the speakers next.
I'm requesting the team to set up the dais with the chairs. And in the interest of time, take a minute, but I'd like to introduce, we have today with us Ian Meg, managing partner from BCG. Just stand up, and obviously get the opportunity to interact with her during IT session. And till then, we'll be patient to start the Q&A. Just give us a minute and then we'll start that. Requesting people not to leave the room and just be seated in your chairs. Thank you very much.
I want to introduce two of our more business partners who are here, Bhavnish and Divya. They lead a design services business and also sourcing from India. They both are based in Noida. Thank you for being here.
Just wait a minute, we will just wait.
I think we can start, Palak will join in, so if there's any question for anybody else, we can take it.
Okay, sure. So please raise your hands and please give your name as well as the name of your organization and who your question is related towards. Yes, please.
Hello sir, this is PDS here. So my question is about, you did touch upon the working capital, we have seen that it is in the negative territory. But what led to this, even before working capital changes, the operating profit shows a negative and after working capital changes last 2 years, the operating cash flows are negative. Can you dwell upon it? That's my first question. Second question is about how do you, what is the product liability? I mean, is it you work on back-to-back guarantee from the manufacturer? Is any product returns or something comes? How do you get this taken care? And what are the terms of product return or liability comes? And third question is about inventory. Whatever inventory we hold on our books, what is the basis of it? Suppose any rejection of a particular lot or something, who is responsible for that? Thank you.
So I'll take the first part of your question. So basically what led to expansion of working capital? So two reasons, like I said in my presentation, we over the last 2 years have seen good growth. Also the market conditions, given that we deal with a lot of large retailers, and then the markets are the way they are in US and Europe, which are our primary markets. It led to, as far as the receivables are concerned, an expansion of the number of days in which we receive payment from our customers. We mentioned about Tech Baker as a business, went through some challenging times, led to a little bit increase in inventory and receivables in this business. And lastly, our manufacturing operations, as I said, did in the last financial year, they posted profitable year. However, given the increase in business they are witnessing, led to some increase in inventory position there as well. So all of these put together is what in the last 2 years we've seen led to an increase in our working capital. As far as your question on, I think you meant operating cash flows or operating profit. We are profitable.
No, sir, you mentioned about receivables, but before receivables also adjustment, operating cash flow shows negative.
Correct. So operating cash flow is a function of your PBT and current assets, current liabilities, and other advances. So if I see an expansion in my receivables and inventory position, it will impact my operating cash flow negatively. So that's the first part answers the second part. If I see an expansion in my net working capital days and net working capital amount, it will have an adverse impact on my operating cash flows.
Yeah, on the other point on
inventory and
so As Rahul was covering, growth led to increase in inventory and receivables. But while we are not slowing down, every organization passes through a journey. But we are not slowing down. We have identified areas through which the inventory can be squeezed by 2-3 days and receivables can be squeezed by 3-4 days. So therefore, the 17 days net working capital that you saw on March 25, we believe there's a room to bring it down by 7 days, the first goal, and in about 2 years come back to negative working capital. Nothing structurally has happened, that requires some kind of surgery. It's a natural evolution, and we are very positive to bring it back. That's number one. And in fact, by the last 2 years, when we have grown and invested into working capital, I remember the many years before that, every year there have been strong operating cash flow generation after working capital changes. So we are positive we are going to restore it back. As far as the product liability goes, there is a strong team on ground which is engaged into quality control. While there is quality control inside the factory from where we source, we also have our own teams who take care of that. So firstly, the probability of any goods reaching the customer and returning is very minuscule, but if at all it happens, we are well protected through a back-to-back arrangement with our vendors. So we don't land up taking any kind of hits there.
I just add a couple more points. So product liability, Sanjay covered. Also product liability insurance for critical products like baby wear. If something happens, then we have the product liability insurance. So that is one area, and that protects us to a large extent. And also in inventory, 100% of our business is pre-sold. So there will be no inventory that we start buying where it doesn't have a home to go to. So maybe the customer, because sales might be delaying to take the inventory by 1 month, 2 months, 3 months. But eventually all the inventory we've got either in our factory for fabric and trims, we manufactured and sold, or if there's any finished garment, they'll also be manufactured and sold. If there's any unsold inventory, is carefully tracked against a PDS policy within a defined period of time, is written down, and once we sell it, we take it back in our book. So it's a very clean way of working.
All this retailer don't return any inventory, right? That is sold is sold.
Yeah, sold is sold. I mean, maybe on the caretaker wholesale model there could be some returns, but there also we factor that in our margins, that there will be this amount of returns coming because of high value branded business. Maybe Steve can throw some light on it.
I mean, as Palak said, all of our inventory is pre-sold, so we are 100 now. Even with the retail partners, we were 100% made-to-order business. So we have 4 selling events a year. We open our showrooms, we open our door. All of our customers, from the smallest independent to the biggest multiple retailers, come into our showroom. We present our ranges. They place their orders. We consolidate those orders and we place back-to-back orders with the manufacturers. Where we have the governance of the PDS group in, we don't sell to anybody that we don't have credit insurance or security, whether that's standby letter of credit or whether that's a payment in advance of goods. We have very, very little returns, in all honesty. Within our terms and conditions with our customers, whether that's our retail partners or our distribution customers, there are terms of endearment, rules of engagement, where any customer returns that they have for faulties, that we will have a 1% threshold within it, which is pretty much within the industry standards. Anything over and above the 1% threshold, we will look at on an individual case, but that individual case will be covered within our terms and conditions of our purchase orders to the manufacturers. At Ted Baker, we work on an AQL 1.5. We do all our own end-of-line AQLs and inspections, and we have terms and conditions with the manufacturers, with our purchase orders, that will cover us with any manufacturing back-to-back.
Thank you, Steve. Next question, request you to kindly introduce yourself before you raise the question, please. Yes.
My name is Ankit Gupta from Istanbul Capital. So I have 2 questions. The first is on the US market. I think any of you can answer the question. So, what we understand from the US market, that the dynamics there are pretty different compared to what you have in Europe as well as UK. It's like 50% plus of the market is digital plus fast fashion. And even on the like model on the Europe and UK side is more of giving equity stakes to our partners or collaborating companies. But here, at least in the what we saw earlier was that you got in some big people from the large who have the sourcing background, and they did not take the equity stake in the company. So if you can address these three questions, on the US side, that fast fashion plus digital, where we are stepping in now, we are making a move there compared to what difference we have in the UK and the Europe market.
Yeah, I think one characteristics that differentiate UK and Europe versus US is we believe UK and Europe is more relationship and engagement driven market, where the US is more like an SOP driven market. That has been historically the trend, and we felt that if we bring experienced people that we had earlier about 18 months back with strong background, and we take them on a platform. When I say platform, means at the corporate level, senior positions, they could actually go ahead and win business. So yes, we did get openings in key accounts. We covered earlier whether it is Walmart, whether it is Target, TJ Maxx, so many nice large accounts opened up. But we could see that the path to profitability was much longer than what we anticipated. Normally, historically, 18 months or worst case 24 months we are profitable. But here, since with due respect to people we brought on board, they were looking at it from a corporate angle, that there is a large corporate funding, so we could take 3-4 years to make money. And so when we departed from our entrepreneurial model that we have been so far practicing, we landed up spending far more money and with lesser visibility. So therefore we took a course correction, and now we have Michael with strong similar background as compared to the previous people, but a gentleman who had the entrepreneurial streak. So therefore now we see profitability from the US business just 12 months down the line. And as a result, that's the course correction part of it. And I think when it comes to catering the online part or the physical part, we have actually set up 2 different teams. There is Andrew Dini, who is based in UK, who's got a similar background of fulfilling the demand that comes from the online business. That's where he's the front end. But then there is Alex, a partner in Shanghai in China. So as you know, China has mastered the art of smaller SKUs, but in terms of faster delivery. So there is a whole network of Alex in Shanghai, and then there is Andrew in UK in terms of catering to this business. So we kind of well organized right now, and also took a course correction. Yeah. So therefore, just to summarize, what we felt last year as a $1 billion potential that we wanted to generate from the US as a market in terms of a 5-year horizon, we believe it's well in place. The path to profitability was coming out to be much more longer, and I think we feel far more positive that 12 months down the line we should be profitable on a US business as well.
Thanks. On my second question, Sanjay, when you one of the key initiatives that you took was to reduce the, let's say, I would use the word cannibalizing or infighting between the different businesses of our group. When they are fighting for the same business or for the same customer or the same category. So how far have we reached in that in our journey to synchronize that and having a process or a model where there isn't much I think for 3 or 4 companies or 2 or 3 companies eyeing for the same business customer or the same category. So where are we in that journey, and what have we done till now to reduce that?
It's interesting when you use the word fight. So I don't think there's any such case over here. Firstly, before I specifically answer your point, relative to our size of 2.2 billion GMV, there's an ocean out there to be tapped, you know. And for example, Primark as a customer, you know, we are one of the largest suppliers to them, currently doing about $260 million of our billing to them, you know, and they wanted to increase sourcing from India. Our current business, simple approach, housed in Hong Kong, run by our partner Sunny Malhotra, has been growing very well, you know, making a lot of money. But we, as Palak said, agility, entrepreneurialism are our characteristics. We felt that the response to Primark to cater to their need to source from India, you know, probably is better dealt with if we have one more team based out of India, other than working with the same team. The same team could have done it, but probably Primark would have moved ahead and we would have trailed behind. But Sunny at the same time is a very mature partner. So we actually sat down with him and he felt that, you know, Palak, I can do far more with Primark, catering to them from Bangladesh. I mean, you know, it's okay that if you want to actually have a different guy. So therefore, with mature partners, one is able to actually talk it through. Then Eric mentioned, you know, that when he came on board, the first 18-24 months were full of accidents in terms of the relationships that he brought on board, you know, from his previous company, customers in North America. 2 customers that he was banking on went into bankruptcy. As a result, the plan went haywire. It is at that moment of time, our existing other business heads, for example, Asta is an account largely served by Poetic Gem. They felt that the account is with me, but I'm not catering to their home and merchandise need. You know, and as a result, that account got opened up for Eric to walk in. You know, so I think we've been working a lot in terms of, you know, mature partners, understanding the need to join hands. And in fact, there is an interesting dimension we've added on our own now. That, guys, we are 2.2, we aspire to be double. You please do your front-end activities, nobody's interfering. But at the back end, let's synergize. When I say we as a word heads, platform telling our vertical heads, we do not intend to interfere into your autonomy when it comes to doing business. But when it comes to admin costs at the back end, when it comes to synergizing on procurement, whether it's fabric or print, that's where, you know, BCG as a partner is helping us. So I don't think fight is a far off word. This is a era for us to more and more synergize and more make money at the back end.
Maybe I'll just add, you know, PDS, we have a new policy. PDS is named, the platform is only called PDS. All our subsidies are being called by name. Wherever a subsidy had a PDS name, we are removing that because that led to flag planting. There was a company, for example, in UK, they will go to customers, they say we are PDS, but there's one of a group companies. So as a company now, PDS is as a platform, all the subsidies have independent names. They sell based on their product competency with the customer. And if a customer asks, then we are like, you have 250 vendors, 2 PDS companies can supply you on different product categories. And you know, in the retail, there are 25 buying departments. Men's, ladies, kids, nightwear essentials, lingerie, active hair, you know, there are like 20, 30 buying departments. And one PDS company cannot serve 25 buying departments. So maybe one PDS company serves 4 buying departments, and then, you know, there are other companies serving other buying departments. So some of our largest customers like Asda, Tesco, Sainsbury, Next, Primark, even Kohl's, you could have 2 or 3 PDS companies supplying them. None of them called PDS, different independent brands, but serving different buying departments. That's where we get the biggest concentration. So now we are identifying which are our top 20 customers where we've not really scaled up beyond $50 million, which are stuck between that 10 to 50, but the door is open, and those customers buying huge amount of billions of dollars of merchandise. So we are seeing how to engage with those customers centrally through the platform teams. You know, we've got a president, a guy called Paul Wright, who will be helping us that initiative, sitting in my office now, engaging with those customers, seeing where the white space is, putting the PDS solutions forward, either on apparel or non-apparel categories, like home, general merchandise, you know, we've got tech accessories, so whatever categories those guys are buying, PDS companies have the opportunity. We are engaging with the retailers centrally and ability to give them those solutions through the already existing verticals we've got in the business. That's the only way to grow business, you know, go narrow and deep with the customer and have multiple entities within PDS, you know, go and service them on different product categories. Sorry, Eric, you want to comment?
Well, I covered it well, but I'll just add one more thing that you heard from me in my presentation was the U.S. retailer is often called as core competency. So within the PDS group, there's 40 plus companies who all have core competencies, and either you're going to allow, which the PDS group looks at, what are the core competencies. So multiple apparel companies are at ASDA because they have specific capabilities, whether they're a tailoring group, whether they're a mass kids wear group, whether they're a GM group. So you take the core competencies and you can plug a number of PDS companies into a retailer.
Hi, good evening. My name is Raman from Sequent Investment. I just want to understand the business model, as in how does the revenue recognition work, the flow from GMV to the top line of the company, and also can you give the revenue split across service as sourcing as service, design as service, and manufacturing?
So, as far as revenue recognition is concerned, GMV and invoice sales, typically invoice sales are 70% of GMV. By invoice sales is what is my reported income in my books of accounts. Sorry, what was the second part of your question?
Revenue split across the three verticals.
So our largest vertical is design-led sourcing. That's about 86-87% of our revenue. Manufacturing is about 6%. Brands business another 5-6%. And sourcing as a service is about 1-1.5% for us. But sourcing as a service is directly accretive to my bottom line, because if I, let's say, Eric does $300 million of GMV with ASDA at a cost plus 1%. So let's say the cost is 3%. On top of that, I charge 1%. So 4% of 300 million is what will flow into my revenue, $12 million.
Okay. And so, with respect to the interest saving cost, because you did QIP and you said you will reduce the debt by 280 crores, what will be the interest saved in FY26?
So we've part of the funds had to go towards reduction of working capital, which we have done. Almost, so we paid an loan of about $10 million that we had taken from one of our bankers for the 10 acre facility. And on top of that, about $22 million further has gone into reduction of our working capital loans across our banking system. So about $30 million for about a period of, I think the funds came in August. They were remitted out of India sometime early November, the $22 million. So, if you do the math, you will get to know our average borrowing is close to about 7%. So $30 million, 7% into close to 4.5 months.
Yeah. And so my second question is with respect. Third question is with respect to the margins. Now that you stated that you will be slowing down the investment across all the segment, and now you expect the US business to be turning profitable, will there be a margin expansion led by not decrease, but a sequential decrease in OPEX cost?
Yes, the answer to both the questions is yes. Like we said, we have a 555 aspiration, wherein as far as top line is concerned, we are pretty much on track. As far as bottom line is concerned, we need to do some catch up. But over the course of what Palak presented, Sanjay and I presented, as well as the vertical heads, there are various levers that we have in place to ensure that the margin not only expands in absolute amount, but also in terms of percentage of margin. So, we pretty much have several levers which will lead to expansion of margin in the next few years.
Thanks, Rahul. Probably we'll take one last question in the interest of time.
Jignesh from Nippon Mutual Fund. Two or three questions. One of the, so as you mentioned about the respective company, you can say, it looks like they are sourcing independently. So just want to take, how is the decision maker now? Is PDS who decide from where to source, how much to source, about the branding partner, or the individual, you can say the partner decide how much to source and where, and will it lead to inefficiency because if partner decides, say, buying $120 million, $30 million from an individual vendor, versus PDS or buying say $500 million from a single vendor?
There is full autonomy with our verticals to actually decide their suppliers, vendors. Basically, when I say supply, it could be factories, they are free to decide, number one, if they are also engaging into nominating any fabric or trim supplier for a factory, again the verticals are free to decide. But having said that, at the corporate level, our job is more policies which are non-negotiable and guidelines which, as the word says, are guiding to the vertical heads. We share information. For example, Bangladesh is about half of what we procure from. My CFO there does an analysis of all the supplier financials. He digs into public information otherwise and share that with all the verticals, that this is how the financial health of the factories are looking like. So therefore he enables them to take a better decision. Secondly, he also collates that with our given factory, are there 2-3 verticals buying, and as a result he shares with them that all you guys put together are half of this factory. So therefore he allows them to manage that risk better as well. So that's about managing the factory interface. Now with BCG's help on board, and prior to BCG, we hired a fabric expert who was earlier worked for Lien Fund. He's based in a Gurgaon office. We hired a trims expert who's based in Hong Kong. We felt that fabric and trim at the end of the day are commodities. But if there is a Nihar sitting in Gurgaon or a Kanai in Hong Kong, they got to see visibility of what kind of fabric and what kind of trims are getting bought over. So therefore we are putting in digitally enabled processes now with the help of BCG, wherein while there is a full autonomy, the merchandiser who is working on an Excel sheet before a price quote is being given, that Excel sheet is sitting in the SAP system, and all of that is getting collated to somebody who at the central level is seeing with which fabric supplier I'm buying, what kind of GSM, what kind of fabric I'm buying. So we are in that journey right now. We would not interfere again into the autonomy, but we will come to this inference from this data. These are my top 10 vendors for fabric. These are my top.
So we don't think like that. You know, it's not that now that we started making money, we part ways. Like I said, never came to my mind, and probably won't. And as it's a partnership that builds this business. If two of us don't partner, this business will never happen. And likewise, when I say PDS synergies was important part of the thing. Even this Conquer app that we are making it's only with the help of the IT team, which is present here. Or if I want to do a fast speed model, which I don't want to create, which is already there. So I'm just introducing my customers who want delivery 30-35 days, which I don't have. And I don't want to make a paraphernalia. I have thing which is, so there is a lot of weave of thread which goes into this whole system, and you can't think separately. It has to go together. Only then you can grow and create that profitability. And to be honest, this is where we come from. We don't come with that mindset that once we grow, we're going to separate. No. I'd rather say if I'm doing 20, maybe I'm showing you 20. I have in mind say about 30. So idea is to grow and not to separate.
So when I left Lee and Fung, and considering what I was going to do, there were regional sourcing positions like the Macy's regional job, or another few retailers were looking for senior executives to run their global sourcing. The last thing I wanted to do was join a company where all I would have to do is cut people. Basically, that's all that they were doing, is cutting and cutting. To Rajesh's point, we're about growth. So if you look at my journey over 5 years, I'm just now starting to see the real profitability come. I want to make money. I want to make you guys money. And my only time that I'm going to leave is when I build my succession plan for the next person who's going to run Casa Collective. So, me and my key management team, we very much see this as our last stop. And that's how we're running it. That's how we treat the business. That's how we treat each other. And we take the core competencies, to Rajnesh's point about the PDS group. It was new for the group to have a standalone GM division, which you would think, okay, it's easy. And I know Palak, we hire good people, but the reality is the group, we have a different factory base, predominantly in China. A large amount of PDS's factories and businesses are Bangladesh. So the compliance program is built on an apparel Bangladesh model. So there's lots of adjusting and learning that we do together, but we get maximum support in some of the core competencies of the platform. And we'll take that, and the other stuff we'll do ourselves. That's not a problem. We're paid to solve problems.
And last part on the working capital, since you're a 40 plus company, individual partner will have their own say on the managing the inventory, working capital, and fungible, and all partner need sufficient amount of cash in the respective balance sheet so that they can aspire for the growth and you can say client also feel comfortable. Will the fungibility of cash be an issue, and hence you always need a heavy on the working capital cycle because cumulatively you maintain all the subsidiary level cash and the working capital also.
Rahul, before you start the answer, this will be the last question for the day. We'll have a session outside, networking session. You can take up any further questions during that. Rahul, over to you. Thank you so much.
So like Rovin mentioned, there are So like we've been mentioning, there are certain areas which are with the platform, which are centrally controlled, and one of them is cash. Our banking is centralized. The treasury team looks at the requirements of PDS group of entities at a holistic level, and wherever funds are required to be deployed are deployed, and hence cash is managed that way. So does that answer your question?
No, but since it is individually 40 company, each partner has their own, you can just say, in the working capital they want to maintain in that entity. And also there is a profit pool, like some company has a high cash flow, as you say, you can say the North America business generating 7% PAT, $100 million. But that case, you may not be fungible to finance other company.
So like I said, cash is managed at a central level. The holdco or the treasury of this group pulls money wherever, let's say Rajnish's company has a cash surplus, but Eric might require that money for working capital purposes or some expansion. I will pull that money from Rajnish's company, but it's all at arm's length. I pay him interest.
Okay.
I act like a bank. I will pay him interest, and if Eric is borrowing from me, he will pay me interest as treasury. Right? So that's how the funds are managed. But at any point of time, if Rajnish needs that money, he will have to forecast it, bake it in his plan, cash flows, and it will be made available to him.
And the banks look at the overall consolidated numbers of PDS and give limits at the holdco level, and all the subsidiaries are sub-borrowers. So the PDS balance sheet strength based on which all the companies are put as co-borrowers. So Axis basic term sheet will have PDS, and then the 30 borrowing entities will be co-borrowers within that. So it's stronger together, like PDS cannot exist without partnerships, partners cannot exist without the platforms, goodwill, network, and also the credibility with the banks. Thank you.
Thanks, Parag. With this, we end the Q&A session. Thank you, all speakers. Thank you, everyone. Thank you, everyone, for joining us today for PDS Investor Day, and look forward to speaking to you all. And thanks for our leadership team for traveling all the way and joining us once again. Thank you.
startup. Whose dedication and passion have driven us forward.